Welcome to the Steadyhand Fund Update. I'm Tom Bradley, Chair and Chief Investment Officer of Steadyhand Investment Funds. Today we're going to review the Small Cap Equity Fund, and to help me do that today I've got Joe Sirdevan, who's the founder and CEO of Galibier Asset Management, the manager of this fund. Welcome, Joe.
Good to see you, Tom.
Now, the last time we did this was a few years ago. Lots changed. The firm has grown and you've built up your capabilities. Maybe you can give the viewers a little bit of a review of what's happened.
Well, absolutely. Thanks very much for having us, by the way. And we're up to about $1.3 billion in assets under management, up from a few hundred million when we last spoke on video, and from a few million when we first started the firm back in August of 2012. We're up to 8 investment professionals in Toronto. We also continue to have a whole bunch of external advisory relationships, and we've been adding to that. So things are good. And
those other advisory clients, what kind of clients are they?
In terms of our overall mix of business, we're about 95% institutional. So we're an institutional shop. That would be foundations and pension funds. And we manage a Canadian product, a global product, and your product here at Steadyhand.
Okay. Now, 2019 was a year of recovery. 2018 was a tough year in the markets generally, and for small cap investing. Maybe you can, and certainly our fund did really well last year. Maybe you can give us a little sense of what drove those returns. What was the fuel?
Sure. So first of all, yes, thanks. I think the fund did about 19.2% last year. The index did 15.8. So, I think very solid absolute returns at 19.2. As you know, in our discounting work, and as we look at valuing companies, we use a 12 to 15% discount rate. So we were well ahead of that. So we're pleased with that. On a relative basis, though, I think we could have done better. So, the strong market in Canada, and we did well, but I think we could have done better. What drove it? Really our process. That's what really drives all of our investment performance, and that's that 2-step process we've talked about. The first is identifying that investable universe based on those 5 criteria. The second is proactively valuing those stocks in that investable universe, and then looking for that discrepancy between market price and our estimate of intrinsic value, and taking advantage of that.
Now, you and your team were more active last year. Markets were pretty dynamic and up a lot, but you had some new additions, some sells, some buys. What prompted that increased trading?
Sure, you're absolutely right. Markets have been very volatile the last few years, and last year was no exception. Our focus is on that calculation proactively of intrinsic value. And so volatility really is our friend. It's the friend of the long-term investor, because we definitely get price moves both on getting things well ahead of our estimate of intrinsic value, which then dictates the sell. And then we have things emerge as sort of fallen angels that, as long as they still are angels, may offer a very compelling value proposition. So we're very intrigued to take advantage of Mr. Market's vagaries, and last year was no exception. So I think over the year, we added 8 new names and we subtracted 5, so net additions were 3. And we're up to 26 names in the portfolio right now, which is probably 1 or 2 more than we'd ideally like to have. We try and keep it at 25 or less.
Well, let's start with the one that's on a lot of people's minds in Canada, SNC.
Right. So SNC, as you know, traded as high as the 40s through the year last year, and traded as low as the 1650 level, I believe. And it was kind of marred by a number of factors, some its own doing and some kind of a cloud of political uncertainty, and became kind of a target during the federal election for Mr. Trudeau to try and wrestle with. So we took advantage of the pullback. We covered SNC from the firm's inception. We think it's a global leader in engineering services. We knew that it had gotten into some trouble with some fixed price contracts on the construction side that we could see through to having an impact on the financials, but not an ongoing impact. Once those contracts reached termination and the settlement was made, we felt that SNC's long-term growth prospects on the engineering side would yield $1.60 in earnings power this year. We also knew that SNC, with its ownership of the 407 and some other global concessions, that's worth about $13 a share for SNC. So when we actually ended up buying the stock at $17.50 or so, we were only paying $3.50 or $4 in value for an engineering company that has $1.60 in earnings power. So we thought it was a very compelling valuation opportunity. Our estimate of intrinsic value buying the SNC was around $26.50, and actually subsequent to our purchase, the stock rallied very strongly. We actually sold some all the way up, and so we have a fairly small weight in the stock right now, but we definitely think it's was a very interesting value proposition. It's up 70% since we bought it, so it's not as compelling as it once was.
So there's an example of why you were more active last year.
Exactly.
That big move.
For sure.
Another new holding last year was Finning.
So the opportunity in Finning came when it sold off over 2019 based on some transitional elements in execution in its South American operations. And we evaluated the story. The stock had fallen down to the low 20s. And our estimate of fair value under any set of expectations about the future, a very conservative view, was probably $27.50. And that's baking in a 15% rate of return and normalized earnings at Finning. And also at that point, we're getting about a 3% yield. So we acted at 22 and the stock's done well. Since then, we're up about 7% on the name. We continue to collect that 3% yield.
So Joe, SNC, Finning, I go down some of the other names that you've added this year. None of them could be defined as hot growth companies. Are you finding that you're having to shift a little more towards call it the value end of the spectrum to find companies to buy? These are good companies, I know, but they're not typically known as growth companies.
Well, you're right. I mean, we're not a growth investor or a value investor. We're a valuation investor. We focus on determining an investable universe of companies that meet specific criteria, and growth is one of those criteria, long-term growth. But if we can buy a stock at a price well below our estimate of intrinsic value, which incorporates those 5 factors and the growth afforded the company, then we're going to act. And right now, in the last year, markets have been quite high. But these fallen angels, as you say, as long as they are still angels, i.e. they still meet our 5 criteria for inclusion in the investment universe, if they've fallen well below our estimate of intrinsic value, then they do offer a compelling valuation proposition, and we will act. And again, we're trying to find the 25 or so best ideas in our investable universe at any given moment.
Joe, just as we finish up, lots of stocks really moved last year, but there's a few in the portfolio that have been kind of laggards. You've held them for a while, you've been patient. Which ones do you have kind of hopes for this year that they're going to come alive?
Sure. So one name that's kind of sold off over 2019, and we think it's a very good company, but it had some operational execution issues that, legitimately impacted the earnings power for the next couple of years, and that would be New Flyer, which is a bus company, both city buses and highway coach buses, has about 40% North American market share. Great customer base in that they sell to municipalities and they sell to a whole bunch of emerging industries. So we're very intrigued about the long-term prospects, and electrification of city buses is a huge area of potential growth. But that has been probably a short-term difficulty for the company because city planners and city pushing agents have to get their heads around how the electrification of the bus system is going to be done, and that's delaying perhaps the typical replacement cycle. Buses have about a 12-year life. It's maybe been extended to 14 years or so now as cities wrestle with that issue. So that's kind of delayed earnings development for the next couple of years. That plus they had, as I mentioned, an operational issue with respect to a manufacturing plant where they had a bit of a mismatch on supply of key components and led to some inventory build that was unfortunate. And finally, they made an acquisition during the year of a double-decker bus company in the UK, like the red, London buses, and they took on a little bit of debt to do that. So the company's debt is a slight concern. So we're very, very mindful of this evolution at New Flyer. We've spoken to the management almost monthly, and we're very confident that they're righting the ship and they've made the necessary management changes to get things moving on both the manufacturing side, and the electrification issue will eventually resolve itself to their benefit. So we're confident about it. Okay. We've actually added significantly to the stock in the low 20s.
And it's one of the larger holdings in the portfolio.
It is, yes. Right. And we own it everywhere, so it's a very key holding for Galibier overall.
Joe, we're going to have to leave it at that, but thank you for coming in and talking to us. And thank you for watching. If there's any questions that come out of this video, we'd love to hear from you. We look forward to seeing you again.